We're going to look at Cumulus Media, which is the third largest owner and operator of AM and FM radio stations. They're just behind Entercom and iHeartMedia. They own 428 stations. And what I do in my videos is I run my discounted cash flow model to look at the true value of a company's stock. Then I look at their financial ratios, and I do this with you throughout the entire video, so it's like we're doing it together. So let's get started with the model. This company has a market cap of $82.2 million. Now we need a stock price, and they're trading at $4.05. And we need to pull the free cash flows. And if you look in Yahoo Finance, they don't have the 2018 free cash flows. So I had to pull that from a different source. Next, we need the net income, which is a profit and loss. And that's on the income statement. And then we need the revenue, which are the sales for each year. That's also on the income statement. Let's take a quick look at the numbers. You ideally want to see free cash flow above net income, because the way you calculate free cash flow, it starts with net income and then you add back the non-cash items. In 2018, their free cash flow was a lot less than their net income. That's because they filed bankruptcy in 2017 and they did a reorganization. As part of the bankruptcy process, the company passed through a lot of non-cash income onto the income statement in 2018. And all non-cash items are deducted from free cash flow, and that's why free cash flow is below net income for this year. The revenue looks pretty steady. They haven't been growing too much. Let's look at a capital structure of the company. The interest they pay in their debt is $76 million. Let's see how much debt they have. We'll go to the balance sheet, the liabilities section. Current debt of $5.2 million. That's debt due within 12 months. Long-term debt of $1 billion. That's debt due after 12 months. And they pay a high interest rate on their debt. Let's go back to the income statement. Let's get their effective tax rate. Income before taxes of $83 million. Income taxes $22 million. The effective tax rate is 27%, so the cost of debt is 5.5%. To get the cost of equity, we need the beta. That's how volatile the stock is. They have a 1.78 beta, so the stock moves a lot more than the market does. Let's go back to their balance sheet and get their current assets. We need this to calculate the current ratio later. And current assets are cash, accounts receivables, and inventory. That's $380 million. Their current liabilities are $139 million. Let's get their equity, that's assets minus liabilities. That's $455 million. That's also on the balance sheet. We need their EBIT to calculate some of the ratios later. That's $132 million. So let's look at that capital structure. The cost of debt is 5.5% and they have 69% debt. The cost of equity is 16% and they have 31% equity. So the weighted average cost of capital is 8.8%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We present valued those numbers back to today using the weighted average cost of capital. That's here in green. And we get a value for the company of $434 million. We divide that by 20 million shares, and we get an intrinsic stock price of $21. They're trading at $4, so they're trading at an 81% discount. So it's a buy according to the model. Simply Wall Street values them at $13 a share, so they're also saying the stock is undervalued. Since the stock recently went through bankruptcy, that may be a reason people don't want to buy the stock, but according to its financials, it's worth a lot more money than it's trading at. The stock was trading much higher a few years ago at close to $20, but it's been dropping a lot ever since. Let's look at their ratios. They have a really low PE, wow, 1.3. Really good price to sales and a really good price to book. So PE is stock price over earnings per share. To get earnings per share, that's net income over shares outstanding. 1.3 is really good ratio. price sales ratio is stock price over sales per share. To get sales per share, that's revenue over shares outstanding. Under 1 is considered a great value, and they're at 0.1. Price to book is stock price over book value per share. To get book value per share, that's equity over shares outstanding. This implies that if the company went bankrupt today, it would be able to give each shareholder $22. That's a pretty good return on investment when your shares are only worth $4. They have a decent current ratio and a low ROE. The current ratio is current assets, $381 million, over current liabilities, $140 million. ROE is net income over equity. So I'd like to see above 20%. They're at 13%, so they're not providing the best value to their equity holders. And the interest coverage ratio of 1.7, so that's a little concerning. They could just cover their interest payments, and they need to be generating more gross profit to improve this ratio. So it looks like a really undervalued company, but there's a lot of risk involved since they just recently filed bankruptcy. Let me know what you think of the video. Thanks for watching.